During the housing crisis, many investors lost their homes and many lost their shirts in the process. Today, we watch as the expansion of derivative products continue to plague the financial system, quickly tearing away at the remaining bits of underlying assets. You came here for the truth, so let me unveil that for you. Today, we're going to have our focus on China. Let's begin. This is guaranteed growth. Implicit guarantees have underpinned the meteoric rise of WMPs. And you can see what has happened, the escalation since the financial crisis of these WMPs, which is wealth management products. Now, I want to talk about this, and I want to talk about one more thing, and that is asset management products. For the purpose of this video, let's consider them to be the same thing. Because all of these different products, whether they are somehow tangible or in paper form, digital form, they are all collateralized, they are all securitized and sold as a derivative product somewhere else from where they originate. And that is very important. I like to simplify things. So that's the way we'll look at it for now. When China unveiled plans on Friday to end the implicit guarantees underpinning asset management products worth trillions of dollars, it should have been a bombshell for the nation's savers. But people who have been piling in, they're saying, we don't need to worry. They didn't believe it. Now that's scary. That's frightening. Because we are talking about $15 trillion worth. I don't think any big banks will dare take the risk of allowing defaults on the AMPs. That will lead to a flood of fund redemptions. That's what the market's saying right now in the US. Look, if they stop printing money and they raise interest rates, the market's going to crash. Therefore, they're not going to do it. And maybe that's true, but how big can a bubble get before it pops? You tell me. I see a lot of gurus out there. Perhaps you can tell me. Now, Tencent. This is a Chinese company here reaching the $500 billion mark. These tech companies have grown so large, far beyond what has happened during the dot-com boom. It surpassed Alibaba, it surpassed Samsung, and is now in the club with the FANG stocks, with, anyway, Facebook, Microsoft, Alphabet, and Apple. It seems to be growing. This is just one stock, but it's interesting to see that Tencent is part of the club now. Outperforming. Hang Seng Index rallied more than 30% this year. And you'll see that blue line is the MSCI World Index, which of course has done well. Not compared to even, when you're looking at Hong Kong stock market or you're looking at the US stock market. But either way, we can see that they have been doing well. But I believe when you give it a more broad picture, you start to see how it's done over the past 10 years. Not just looking over the past year. How has it done since the financial crisis? Record rally. All right. So we are looking now at the Asia Pacific Index, right? It has now surpassed its previous high in nominal terms. This is where it was before. So that's financial crisis timeline. It has now surpassed it. But what I think is important is the fact that the timeline it took to get back to this level, 10 years to break its previous high, not factoring in inflation. Yet, when you hear all this talk, they would constantly talk about how well it's doing, it's so great, and everything else. But when did people buy in? Maybe they bought in along the rally. Hey, maybe they bought in somewhere in the middle and they've been able to profit ever since. That's great. But perhaps a lot of people, or pension funds or people who have been holding their, retirement accounts of any sort, maybe their different portfolios that they have, I would have to factor in, they were buying in maybe a little bit of time along the way, and then they lost a lot on the way down. Now, yes, maybe they've been adding to their positions ever since, but nobody wants to factor in the losses that are experienced along the way. I covered this recently, talking about the fact that in any crash, you're going to lose an average of 50% of your portfolio. And that's just historic normals. Look at what happened during the financial crisis. It was even worse, in fact, 100%, greater than 100%. China's leverage, and just to clarify what I meant by that, we're talking about the gains you received in the previous bull market, okay? All right. China's leverage pile has many moving parts. The load has swelled since the global financial crisis. You're taking all of this, I'm going to show you individually, but whether it's the WMPs, whether it's shadow banking, you can see that while this has absolutely increased over the years, I have noticed stagnation taking place in this last year. Now, I think it's too early to tell because there are always blips along the way. There's no way to really define something by, what happened in a short period of time. When you look at it over a longer chart, 20 years or something, you start to get a better picture. But it's a trend. So we'll see. There are some information here on the left-hand side if you're interested to read that, but I'd like to move on. Looking at this here, this is the WMPs struggling recently, and I believe because of what has happened with the government saying, look, we're not going to guarantee this anymore. We're not going to backstop this, and we will, in fact, let it fail. Now, people have been thinking, well, okay, I'm not going to put my money in there anymore. Others are saying, I'm going to stay in. So this is causing a little issue here. I'm not really sure what's going to happen with this because the government, to be able to bail out $15 trillion, will be a huge burden on them. Even the US, when they had to do so with Fannie Mae, Freddie Mac, and all the other companies, we're talking about trillions of dollars put onto the back of the US taxpayer, and that's huge. Doing so in China would be even, more serious. Whether the central bank can print up the currency to do so, I don't think so. I don't think they'll do $15 trillion worth. Whether all 15 trillion is going to fail, I don't think so. But if it starts to tumble, you'll see it quickly evaporate. This is the NBFI loans, non-bank financial institution loans. Well, RBS is calling it a black swan. I don't know. I think the term is overused. Anyway, but we need to see velocity, and that's a problem that is existing, I would say globally for the most part, that you're not seeing the velocity. Money needs to change hands, right? It's currency, like a current. It needs to constantly be moving. If it just sits under your mattress, this is really bad for the bankers. Okay, you need to take that $1 you have and you need to go to the store. You need to buy something with that dollar. And then that dollar needs to go from that cash register and it needs to be sent out through the banking system and loaned out to someone else. And that loan goes, it has to keep moving. If not, that stagnation causes a very big problem because the system runs off of that. It's a very silly system, but of course it's designed intentionally. All right, just one more here. Shadow banking. Now, shadow banking is something that it shouldn't even exist. But of course, it's huge. It's massive. And we're talking about trillions of dollars worth. Trillions of dollars worth here. But it doesn't seem to matter. No matter how many risks you pile on top of a market, as long as the government says we will backstop it, we will have the central banks, we will take care of any losses, there will always be a reason for it to rise continuously. That's what you're seeing with the US stock markets, for example. So this is what we need to watch out for. All those risks that are appearing, all the cracks that are there. Eventually, okay, it might be 5 years from now. A lot of people criticize me every video. Give me a thumbs down. Give me a thumbs down, please. Do that for me. Do me a favor. Perhaps those in 2006, 2007 that were warning about the crisis that was unfolding, saying subprime was a threat, saying that derivatives products were a threat, they were laughed at, they were ridiculed. And the exact things that they were talking about eventually were the reason the stock market fell. It took a while, but it happened. And so, today, we see the same thing happening. I don't want to be here to have to, give you that warning in such a way, but unfortunately, it's so apparent what's happening. But I will mention the fact that, look, as long as the Fed's there to print money, the US stock market is probably going to go up. That's the way I look at it anyway. As long as they're willing to keep interest rates low, as long as they're willing to print money, should they need to engage in QE4 if things start coming down, the market will just continue to rise. Along the way, the currency itself, that's what the stock market is measured in, is being devalued. So that's all for this video. If you found it informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature that's going to allow you to flip through the pages of these books to see if you like them. Take care.